Hey everyone, what if I told you a company just revised its annual revenue upward by as much as 33% and is now projecting a potential five-fold increase next year? Today we're talking about Datavault AI, ticker symbol DVLT, and the numbers that just dropped could completely change how investors look at this stock. Let's break it down carefully. On February 17, 2026, Datavault AI released updated preliminary results for fiscal year 2025. And here's where things get interesting. The company now estimates revenue between $38 and $40 million. That's not just a small adjustment. Their previous estimate was $30 million. That means they increased their guidance by $8 to $10 million. In percentage terms, that's roughly a 27 to 33% upward revision. But the real headline isn't just beating their own estimate. At the midpoint, about $39 million, the company says that represents approximately 1,300% year-over-year growth. Let that sink in. A 13-fold increase compared to the previous year. That kind of acceleration doesn't happen by accident. According to the company, this growth was driven by two major engines. First, customer technology licensing fees. Second, their data science group, which focuses heavily on tokenization and monetization services, including real-world asset tokenization. And that's important, because tokenization and enterprise AI adoption are two of the hottest themes in the technology space right now. Companies across multiple industries are experimenting with AI integration, digital asset frameworks, and new monetization models. Datavault AI appears to be positioning itself directly in that demand wave. Now here's where the story becomes even more aggressive. The company didn't just raise its 2025 estimate, it also reaffirmed its fiscal year 2026 revenue target, $200 million. $200 million! If they achieve that number, it would represent 400 to 440% growth year over year. Compared to the midpoint of 2025 revenue, that's about a 413% increase. In simple terms, they're projecting another quadrupling of revenue in just 1 year. That would effectively be a 5 times jump from 2025 levels. And management seems confident. CEO Nate Bradley stated that exceeding their prior 2025 estimate while maintaining the ambitious $200 million 2026 target reflects the mission-critical nature of their platform and the operational leverage they've built. He also mentioned that the company finished 2025 strong and is entering 2026 with what he described as the most robust new business pipeline in company history. That phrase matters. Clear line of sight to revenue objectives. It suggests that much of their projected growth may already be supported by active deals, customer expansion, or advanced negotiations. Bradley also highlighted something else that investors should pay attention to. In 2025, the company added new customers across a wide range of industries. Many of these customers initially started cautiously, testing enterprise AI, experimenting with asset tokenization, and exploring monetization tools. But here's the key part. Management expects high retention rates in 2026 and anticipates many of those customers will increase their level of engagement. That means upselling, expansion, larger contracts, deeper integration. And in SaaS-style or platform-based models, customer expansion is often where margins and revenue acceleration really compound. Now, before getting too excited, there is an important detail. These 2025 numbers are preliminary and unaudited. The company's independent auditor has not yet reviewed or finalized these results. Datavault AI also stated that the actual audited results could differ materially. That's standard language in early financial updates, but it's important for investors to understand that these numbers are not final. The official audited 2025 financials are expected to be filed with the SEC next month. So what does all this mean? At minimum, Datavault AI is signaling extremely aggressive growth expectations fueled by enterprise AI adoption and digital asset monetization services. If the company delivers even close to its 2026 projection, it would represent one of the more dramatic revenue scaling stories in the small cap AI space. But projections are one thing. Execution is everything. The next few quarters will be critical. Investors will want to see continued customer expansion, strong retention metrics, improved margins, and confirmation that the pipeline management is talking about converts into real revenue. Because when growth accelerates this quickly, the market starts asking tougher questions. Can they scale operations efficiently? Can they maintain profitability or at least control losses? Can they sustain customer demand beyond early adoption? Those answers will determine whether this becomes a breakout AI growth story or just another over-optimistic projection cycle. For now, the numbers are bold. A revised 2025 revenue estimate of up to $40 million. A projected $200 million in 2026. And management expressing confidence backed by what they describe as their strongest pipeline ever. The next step, watching whether those projections translate into audited results and real, measurable execution. Because in high-growth tech, especially in AI and tokenization, the difference between explosive upside and major disappointment often comes down to one thing: delivery. Stay focused, watch the filings, and pay attention to how this unfolds over the coming quarters. This could get very interesting. This is not financial advice.